Hello and welcome to this Diwali special co-presented by Motilal Oswal. I am Nandita Khemka. Well, Samvat 2080 has been phenomenal for the markets. We've seen a spectacular 30% up move on the Nifty itself, and we've seen a very smart surge in domestic liquidity. And, investments in equity mutual funds have grown leaps and bounds. And of course, India continues to be among the fastest growing economies in the world. But what does the outlook really look like for the market, and what sectors should one be watching out for in the new Samvat? To discuss all that, we are joined by Siddhartha Khemka, who's the head of retail research at Motilal Oswal. Siddharth, great to have you on the show. First of all, as I mentioned, it's been a phenomenal 30% kind of an up move on the Nifty since last Diwali. But this time around, going into the new Samvat, we are, pretty much somber given the fact that we've seen quite a bit of a correction, from highs, a 5 to 7% kind of a correction. But, the key culprit here is the FII sell-off. It's topped $10 billion record FII sell-off, right? How is it really looking like going forward? What is your sense?
Yeah, thank you. First of all, I would like to wish everybody a happy Diwali. So if you look at last few years, FIs have been building up a lot of positions in Indian markets, and the overall weight in the Indian equities have grown significantly in the last 3-4 years, from about 12% to now more than 20% if you look at the MSCI Emerging Market Index. So India has far significantly outperformed, and the weightage has become overweight. So I think some bit of rationalization in the portfolio allocation is taking away funds out of India. It's also some profit booking that they would do. The good part is that to counterbalance that outflow, now we have a very strong domestic inflows, both from the DIs, from the retail, from the HNIs, which is kind of taking a cushion to the overall market. The best part is that the fundamentals remain pretty strong, both in terms of macros as well as in terms of micros. We have seen consistent improvement in the GDP growth. We have seen low inflation, and in terms of earnings growth, we have seen pretty steady earnings growth for the last few years. So in the near term, with the outflow of FIs and the earnings slowing a bit on a quarterly basis, could lead to some consolidation in the market. But if you look at on the longer term picture, I would believe that Indian economic growth would pull back, and that will lead to flows coming in and market giving us steady returns from here.
Okay, we've seen a 7% kind of a correction from the top. What kind of, valuation correction should we expect from here? Do you think valuations are still expensive? And is there scope for more 8 to 7% kind of a correction? Or, how much of a correction should one really expect from here on?
Yeah, so actually this is a very good question, because you have to look at the earnings growth in conjunction with valuation. Valuation by itself will not give you a clear picture. So in terms of Nifty valuation on a 1 year forward basis, we are trading in at about 20-21 times on a 1 year forward basis. And if you look at next 2 years earnings growth, the Nifty earnings growth potential is about 13 to 15%. So I would say another 5 to 10% correction, so around 18 times on a 1 year forward, that will be a good healthy correction. But that may not happen because, as I said, yes, in the near term, a consolidation can happen, because this quarter we are not seeing any earnings growth. A lot of margin pressure is coming. Volume growths are not seen across various sectors. So that could lead to a time correction in the interim. But again, when the earnings growth pick up to 12 to 13%, market should give you about 13 to 15% return. So again, going back 3 to 6 months, we could see a consolidation with another 4 to 5% correction. A lot of sector rotation will happen. So this is not a one market all kind of a scenario where the entire mid cap was going up or the entire mid cap is correcting. So you saw a lot of stocks correcting after weak results, but we also saw today a lot of IT stocks, especially in the mid cap space, coming out with good numbers, and the stocks are up 10% in a single day, and they are at all-time highs. So market is clearly looking at quality and growth in terms of rewarding, as well as in terms of punishing companies where valuations high and earnings are not commensurate to the valuation.
Okay, before we get into sectors as to which ones are looking good and which ones you should be approaching with caution, I want to ask you, what are the key risks that you envisage in the new Samvat? Would that be China? Would that be earnings? Because you said you could expect 2-3 more quarters of poor earnings. So key risks for the entire Samvat, which ones would you list out?
Yeah, so I think the biggest risk for the market is earnings growth. I think valuations follow earnings. So if earnings growth continue to remain somber for some more time, I think that could lead to even more correction, because still people have faith of earnings recovery happening after 1 or 2 more quarters. There are sectors where we are seeing better earnings growth, so sector rotation will keep happening. But I believe China may not be a big factor. If China growth happens, there are certain sectors which will definitely be benefited. For example, your global cyclicals for metals, oil and gas space, they are currently under pressure, and with China growth improving, coming back, that sector could start performing again. Yes, there could be some outflows towards China, but if you look at again from a global perspective, India continues to far outperform in terms of growth, be it your GDP growth, be it your earnings growth, and China has underperformed. So the weightage in China in global portfolios have been from an underweight to now gradually they will become an equal weight. So again, it's a mixed outlook from there. But as I said again, the biggest risk would be your earnings growth, which could be from your commodity prices. So your geopolitical tensions could lead to a higher crude oil prices, which is one of the biggest raw materials for a lot of sectors. China factor could lead to improvement in metal demands. Again, metal prices going up, a lot of sectors we could see margin pressure, and that could lead to an earnings subdued earnings growth. So I see clearly earnings being a single biggest risk, and clearly margins being that factor that could drive pressure on earnings.
Right. Let's talk about sectors then. Since you're talking about earnings, we've had earnings from some FMCG names, coming in, and there have been clearly a disappointment in terms of volume growth as well as margin growth. And even looking at autos, we've seen the rally slow down a bit, right? There's a cyclical slowdown that's playing out in autos as well. After the dream run in autos, would you approach a sector with caution? Because of course we've seen sales for passenger vehicles also take a hit, and of course there are question marks about how good a festive season this will turn out. Early days still, but still, how would you approach the auto space and FMCG that saw a very good comeback post elections? Even that has kind of showed signs of stalling. So these two sectors, do you think these are the two sectors that one should actually rotate out of and look at moving into other sectors which are looking a little attractive now? Yeah,
definitely. I think let's take the auto sector first. Clearly, they have far outperformed a lot of other consumption space in the last 1.5 years. And with current growth kind of seeing a slowdown, we have seen both in passenger vehicles, in two-wheelers, passenger vehicles inventory levels are building up. OEMs are offering discounts in the festive season to pick up sales. We heard the management of Bajaj Auto talking about a weak growth in the Navratri festival and not that positive outlook even from the Diwali festive season. So I think autos clearly in the near term could consolidate with the lower growth. But that is one sector which generally does well in an Indian economy where the automotive penetration is still improving. You have a lot of demand for two-wheelers, especially with the rural economy doing well. So that brings me to the second segment that you talked about is the FMCG space. Clearly, again, commentary suggests that the rural demand is improving and outpacing the urban demand. So it's kind of counterbalancing the urban, which is taking a pause while rural is picking up. Again, within the FMCG space, you have certain pockets which are doing well. We saw the results from Varun Beverages, much better than Tata Consumer. Tata Consumer had its own challenges in terms of growth in India, plus some of its global markets. You have the bigger consumption space like DMart, retail. We are seeing some slowdown in the grocery side or the staple side, but the bigger discretionary spending, for example, the retail segment or the textiles, the garment segment, there we are seeing good growth. Companies like Trent, Aditya Birla Fashion, they are reporting better numbers. So within the overall consumption space, you have to be selective, and I would see that the staples might underperform in the near term, but some of the discretionary spending that could see some growth.
What about quick commerce? Is that a very hot space to be in at the current juncture, with Swiggy IPO also around the corner, and Zomato also pulling all stops to ensure that they are well prepared to deal with Swiggy once it comes into the market?
Yeah, I think that is something which the market is very excited about. We had our own doubts with regards to quick commerce when Zomato acquired Blinkit. but now the entire world has come to a conclusion that this is a business model which can become profitable, which can become scalable. There were a lot of questions about whether this model will survive in tier 2, tier 3, tier 4 cities. But now we have enough of examples where the Blinkites and Zeptos of the world, the dark stores are becoming profitable in tier 2, tier 3 cities, and that brings me to Zomato. They are raising funds, which again kind of the street was surprised because they've started making a lot of cash flows. But yesterday the management clearly laid down their thought process with regarding to building a war chest with the competition hitting up, Zepto getting into a lot of these smaller towns, so they want to also get their investment, and this is not a cash burn compared to what we had seen earlier in the food delivery business. So I think quick commerce business is here to stay. It will scale up, and that will be a profitable business model for not only Zomatos or the Swiggies which is coming with that, but we'll see a lot more players getting into this space. Reliance will get into that space. We are seeing Amazon looking at that space, how they can do that. A lot of consolidation may happen, and acquisitions and investments could continue. So we are clearly positive on this space.
What about banks? We've had numbers from a few banks as well, but HDFC Bank has been an outlier this quarter. Look at some of the other banks. There has been MFI stress and stress in the credit card divisions as well. HDFC Bank is just about starting to perform, so to say, if you look at the stock movements. Do you think HDFC Bank will take the lead when it comes to banks and entire banking space? Do you think it's primed for a good up move in the coming Samvat, or do you say that entire banking universe, including PSU banks, will fire up?
So yes, financials, especially banking, is one of the space or sectors that we feel can do well in this upcoming Samvat. But we remain positive on the private banks, especially some of the larger private banks, because we believe they are positioned well to navigate the current uncertainties and deliver growth. What is also comforting is that valuations are comfortable, and we have seen results from Axis where growth visibility is improving. So we expect with growth improving and the stocks delivering, so we expect the re-rating to happen within the larger space. So stocks like an ICICI Bank, which has consistently delivered strong numbers. HDFC, we are becoming more and more positive with the earnings delivery starting to happen. There were a lot of concerns with regards to deposits growth, and the management has shown that delivered in this quarter. Deposit growth has been much higher compared to your loan book growth. So next 2 years we'll see management focusing on the deposits and the cost, the credit to deposit CD ratio improving. That will lead to again investors' interest coming back to ICICI. Axis, after 2-3 quarters of weak numbers, have delivered good numbers. The management commentary has improved. So I think that is one space where you have growth visibility improving and valuation comfort as well.
So if I asked you to list out 2 to 3 sectors that one should be invested in the coming Samvat, which ones would you pick?
So again, in terms of sectors, what we like financials, in that also private banks. Another space that we like is technology and the overall digital space. We believe some of the IT companies, they have delivered good numbers. Guidance have been improved. We expect with the Fed rate cut next year, starting the Jan-Feb March quarter, the budgets for a lot of these companies in the US, they will be declared, and that could improve with the interest rate going down. Healthcare is another space where we believe that earnings growth visibility is pretty strong. Valuations are comfortable. That could be another space to look at. And then you have some of the industrials, the Make in India theme. For example, you have the EMS space that could do well. You have some of the niche defense companies that could do well. And you have the overall infra space that continues to deliver in terms of order book.
Okay, let me get a little more pointed now and get a little more micro. I would ask you to list out 2 stocks, stock ideas for the long term, and 2 stocks for the new Samvat.
2 stocks for the long term. Yeah, so basically if you look at 2 stocks that I like, I can suggest from a Samvat perspective. First is from the quick commerce, the space is that is Zomato. The core food delivery business has become stable, and growth is being witnessed in the new segments. The Blinkit, which offers a once in a generation opportunity to participate in the disruption in the retail, grocery, e-commerce space. Hypersure business is stabilizing and improving, and Zomato has prioritized investments in the quick commerce, focusing on expanding Blinkit, entering into newer cities, enhancing its presence, diversifying into various categories like your electronics and other segments apart from the foods and staples business. So that I think would lead to a strong growth. Margins are improving on an overall basis. So we are forecasting a margins of 4.7% in FY25, 8.6% in FY26, which should lead to good cash flow generation as well. So we have a buy rating on Zomato and a target price of 330 on that one. The second company from the mid-cap space again is from the EMS, which is Keynes Technologies. It is scaling up its business across segments. It recently entered into the smart metering business and set up a new factory in Hyderabad. So that is also growing. That is expected to grow fast. The company is setting up an semiconductor OSAT plant in Gujarat, which will come up over the next 2 years, which will drive the long-term growth. So I think Keynes is set to not only benefit from the increasing manufacturing of electronics, but also getting into the semiconductor business. So very strong growth, almost 60-65% growth in the next 2 years, and from there you will have the added growth of the semiconductors. So that company we like. We have a target price of 6,400 on Keynes. So these are the two picks one should look at from the Samvat perspective.
The other was for the long term.
So yeah, so from a long-term perspective, one can look at again those themes that we are looking at. Banking, financials. If the Indian economy is to grow to a 5 trillion economy, banks and financials will be the key sector to focus on. Within that, within the large caps, you have ICICI, which is a market leader, which will continue to do well. Within the mid cap space, you have Cholamandalam Investment and Finance, again from the group which has done significantly well across cycles, manages well. So that is one company which could do well. Another space that we like a lot, which goes in sync with the overall digital theme, is the telecom. We see Bharti Airtel taking the leadership there, consistently delivering numbers. Cash flows have improved, debt has come down, and with rollout of 5G across segments, we believe ARPU growth will continue to happen. Digital adoption will happen. We have seen a lot of demand for data centers. Again, Bharti will be a beneficiary of that. So Bharti Airtel is another stock that we like. Pharma, as I said, the next 2-3 years could do well with improvement of growth in the key markets of US, Europe. So within that, Cipla is a preferred pick. Divi's is a preferred pick. So these kind of themes, stocks that we like from a long-term perspective.
Right. Also one more question on what one should be doing with defense stocks now, because most of them have come off 30 to 40% from their record levels, right, after having a dream or spectacular run. Is it time to take out or take some money off the table there, or is it okay to stay invested?
Yeah, it's a very important question because defense has done well for the last few years, and my guess is that valuations had run ahead of fundamentals. So there is some consolidation that can happen at least for the next 3 to 6 months. They are sitting on a huge order book, but the execution will take its own time. So I think it's a 5-year, 10-year story. Let the valuations, the stock prices consolidate for some time, and then maybe another 6 months from here, we could see the next run of rally in defense.
Okay. Also, just last few questions really. What's your advice for building a strong long-term portfolio during the Muhurat trading session?
Yes, I think Muhurat trading is very important. It marks the new calendar from in the Hindu calendar. A lot of people start afresh during this time. So it definitely helps to start during this time. Building up a new portfolio, you should look at least 3 to 5 years stocks and sectors which will do well. India's growth story will do well over the 3 to 5 years. India is one of the fastest growing economies, and you have to select sectors and stocks from this space which will continue to deliver, and you have earnings comfort as well, and you gradually build it over a time. I would suggest you don't go lump sum in one go. It's a time where we are looking at market consolidating over the 3 to 6 months. So you go in 3 to 4 tranches. So you invest 25% now in the Muhurat, and then you build up over the next 2-3 months with the quarterly season getting over. We'll get the new year budgets for the US. We'll also have the RBI starting with its rate cut cycle. So a lot of developments are lined up from a domestic standpoint.
Right. And should new investors really participate right now, or should they wait for some more correction before entering into the market?
So it's, Nandita, it's very difficult to predict a correction. The best time to invest was always in the past or now. So I would suggest, yes, it's a good time. Market has seen a 5 to 6% correction from the top. A lot of mid and small cap companies have seen even higher correction, 15-20%. I think that the result season is giving us a good opportunity to select stocks and enter into the market. So definitely I would suggest, if you have not entered so far, it's a good time. But again, don't go all in right now. Put it in tranches. 3 to 4 tranches would be a good investment strategy in the current market environment.
Also, would you consider it auspicious to start investing journey on Muhurat,
Yes.
in Muhurat trading session? What is the significance of starting to invest during the Muhurat trading session?
So I do participate in Muhurat trading sessions. I do buy a few shares on that day or invest in some of the funds on that day. I think it marks an auspicious time in the Hindu calendar. It's more about the sentiments with the event and with the time rather than any significant point in terms of market. So I think it gives us a more confidence that when we invest in this time, the investment will do well and you hold on to it for a longer time.
Right. Well, I think this wraps up our discussion for today. Siddharth would like to thank you for coming to our studios. Wish you a very happy Diwali, and it was a great chatting with you.
Thank you.
Well, with that, we've come to the end of this Diwali special episode on Money Control. Thanks a lot for tuning in. Wishing all of you a very happy Diwali and a very prosperous New Year. Stay tuned to Money Control for all your other news and updates, and have a great festive season.